Hey everybody, it's Cullen here. I want to show you something really cool that I've been working on that has really transformed the way that I not only think about a lot of my planning and advisory work, but also the way that I think a lot of other financial advisors can sort of transform and differentiate their business. So the tool that I've built is called HourglassFP Pro, and it's designed around a very specific methodology that I developed called defined duration investing, which really tries to quantify the time horizons of different assets that we use in the investment management process. And this is derived from the process of asset liability matching, which is a process that banks use. A lot of people in the industry call it liability driven investing. And it's very different from modern portfolio theory and the old frameworks that we used to use, that I used to use. And this process is based much more so on establishing a financial plan and then matching very specific assets to very specific goals across different time horizons. And so this is a very different process than what we traditionally do, where you're looking at something like a very subjective behavioral risk profile, and then you're slapping on an asset allocation of something that may be diversified across factors and styles and things like large cap growth or small cap value. And these things that, although are theoretically understandable, really communicate nothing to actual end investors in terms of understanding what is the purpose of this instrument inside of my financial plan. This flips all of that upside down, completely transforms the whole communication and everything that you're doing, so that when someone looks at the portfolio, they actually understand exactly what are the roles of very specific assets in terms of my financial plan and my goals across life's varying needs. And so we're going to walk through all three modules: the ALM tool, the risk assessment tool, and ultimately the portfolio builder. This thing is the pro version. There is a basic version on the Discipline Funds RIA website, but this is the pro version I'm going to be going through, and it's really designed for financial advisors because it follows a very specific sort of financial advisory workflow. So let's jump into it. All right, so the first module in Hourglass FP is the asset liability matcher, and what we're really trying to drill down into here is life's most predictable expenses across very specific time horizons. I like to focus primarily on the sort of 0 to 7 year time horizon for predicting this stuff, because frankly, anything much longer than that just becomes much more guesswork. We really don't know not only what the financial markets are going to look like in 10 or 20 years, but you really have a very hard time predicting your expenses and liabilities out over those time horizons. So in Module 1 here, it's really important to get the short-term stuff right. And this builds a baseline for then building the portfolio that's going to match to a lot of this stuff. Because if you get the short-term stuff right, a lot of the long-term stuff will begin to take care of itself. So let's drill down into this, a real-time example here where let's just assume this person's got $2 million. Looking at monthly expenses, you can get very granular with this. You can add a whole bunch of other inputs and whatnot. I typically like to just use a monthly manual override on this. So let's say this person, let's say they spend $120,000 a year or so. So roughly $10,000 a month. Again, you can get as granular as you want, and you can, model this out very, very granularly, but rough figures are going to do a lot of the heavy lifting here. So let's say that these people are driving an old beat up car. They would need to buy something new. Let's just say at some point in the next 3 years. Let's say that they're looking at a new house and they want to do that relatively soon. So that's going to be year 2. Let's say they've got at least one 10-year-old kid and they're going to college, and college has gotten crazy expensive. So 150 may not even cover it there. And then let's say that this family, they have an old bathroom that they want to remodel, and although that's probably also going to cost more than $25,000, let's just throw in 25. And let's do that in year 3 as well. So again, you can get very granular in here. You can throw in a whole bunch of other large expenses if you want. The more the merrier. If you leave component 2 blank, it'll fill in a default figure for you because as I'll explain later, we're covering for sequence of return risk, and also the multiplier will map out your monthly expenses out over 0 to 7 year time horizons anyway. So I like to apply a margin for error to all of this. Nobody knows what things like inflation are going to look like. So what this does is this will automatically build a set of underlying baseline buckets for us. And so this is now establishing all of our most essential needs basically for the assets that have to be matched to very specific goals across very specific time horizons that we know. And so you can see all of this is mapped out in a baseline, a set of assumptions so far. Now, step 2 is where things start to get really interesting, because this is where the process really begins to differentiate itself from the traditional financial advisory process, because the old way that I used to do this, and the way that I'm sure most advisors do this, is with a very subjective risk profiling process. It's a bunch of phony questions, how scared do you get when the stock market goes down or something silly like that. This is totally different. This is based on your risk capacity. And what this is really measuring is it's really measuring the health of your balance sheet, the size of your liquid investable assets versus your income statement, in essence, the health of your income versus your expenditures across different time horizons. And so we'll see within this that someone who has a very, very large balance sheet relative to the size of their income statement will have a much, much higher capacity to take risk. But what this is not doing is it's not measuring some subjective behavioral process and then slapping on an asset allocation based on behavior. This is very specifically quantifying the risk capacity. So this pulls in all the previous data. It sums our large expenses, and don't worry, this all gets inflation adjusted and adds a multiplier of varying degrees in the next step of the process in Portfolio Builder. But for this example, these are all customizable inputs as needed. Let's just say that this family makes $250,000 a year, so they're good savers. Let's say they're 45 years old, they've got 20 years to retirement, income is very stable. We're going to target a 6-month emergency fund. That number may or may not be altered by the output here. They've got a little bit of debt, and let's say their future planned withdrawal rate is going to be sort of an industry standard 4%. We're looking at an estimated 6% nominal return across the whole portfolio here, and this is the only behavioral component here. But it will have a relatively small weighting. But what this does is it outputs a risk score. And so you can see this is broken down by a whole bunch of different factors, including your coverage ratio, your time horizon, your savings, your emergency needs, and behavior is an element of it. But this is very, very heavily weighted towards the quantifiable metrics and the risk capacity of the balance sheet. So you can see if we change this figure to $1 million, for instance, the risk score completely changes. And what the risk score is doing is it's establishing a multiplier for what Portfolio Builder will ultimately build. So basically, though, to understand why that number changed the way it did and the way that it can transform across different inputs in this is that it's really getting into a measurement of how much money do these people have in their balance sheet relative to the size of the health of their income statement and the risk that they're going to potentially run out of money going forward. And so the algorithm inside of the risk score assessment is actually running something similar to sort of a Monte Carlo simulation in the underlying before it assesses what the risk score actually is. So let's put this back to 2 just for consistency there. And then let's get into the really good stuff. Now, Portfolio Builder is a highly customized portfolio builder, as the name states, that will give you a full asset allocation, the actual outputs, And most importantly, it builds it in a fully asset liability matched manner. And it's applying all of these very specific goals that the client had. And you can customize this in various ways. Some people like insurance. I default it to stocks and bonds to begin with. I have a lot of people that I work with who like using forms of insurance and alternatives. I don't have a problem with that, but this is customizable at the advisor level. So you can also add tips ladders into this. You can add a factor tilt if factor investing is your thing. You can add a bond tent allocation. I typically would do something like that for somebody who is maybe near retirement or just entering retirement. The default setting on this optimizes the T-bill ladder for live yield. So this is actually pulling in live Fed data for interest rates, and then it's weighting the T-bill ladder based on an optimizer that I built that is basically trying to optimize for the highest yields while also considering the time horizons over which we need to have certain things. And so if you want to keep things plain dead simple, you can just click ETFs only. Some people don't like building individual T-bill ladders. I do, just because I'm a masochist for building bond portfolios. But you can see what's going on here is this is sort of a very traditional looking asset allocation perspective where we've got 69% of the portfolio goes into stocks. The reason that even with a risk score of 10 that we're getting so much blocked into bonds and cash is because this person has a lot of short-term needs. And so the portfolio is forcing a lot of assets into the shorter-term bucket, but ultimately it's trying to push as much of the assets out into longer duration instruments, higher risk things like equities as possible. And you can see then it's all broken down by a various set of more granular set of actual instruments here. And if you were to come to me with this portfolio, this is roughly what the builder will output. It will output a very specific structured T-bill ladder, and it will use basically nothing but low-cost ETFs. This particular portfolio has an annual cost of $2,500 a year, 0.13% estimated weighted expense ratio. So very low cost, very diversified. But this is the big differentiator for me, is that what this is doing is this chart is technically the same thing as this chart, but this chart communicates a very different story. This communicates, are you temporally diversified? And you can see that this particular person comes out with an asset allocation where all of their short-term needs are covered. They know that they have money allocated in an inflation-adjusted set of instruments that are matched specifically to those short-term goals. But they're also covering their sequence risk. And what I mean by that is that their portfolio is diversified across very specific time horizons, because in an asset liability matching process, you need to be able to ultimately refill short-term buckets. And one of the main goals of that is to never fund from long-term buckets, but knowing that there will be times where inevitably you have to refill from longer term buckets. And so you want to map this out in such a way where you don't have big holes. You don't have big asset liability mismatches, because what happens when you fall into a situation like that, you become something like Silicon Valley Bank. If you remember that situation where they had a huge amount of long-term assets, they had a lot of short-term liabilities. And when those short-term liabilities were exceeding the value and the liquidity of the long-term assets, they go out of business. And retail investors have all the same problems that banks do. And it's very interesting that the industry does not utilize any sort of process like asset liability matching at the retail level, and instead focuses on typically high fee sort of factor based or styles of investing that the average person, frankly, just does not understand, or does not understand how that actually maps to their financial goals. This is completely differentiated. And The asset liability mapper is actually the coolest part of this because it'll actually take out everything that we mapped out earlier, all of the liabilities and expenses that we mapped out earlier. It will show you your inflation adjustment, and it will map everything specifically to the sets of instruments needed to fund those specific goals. And so you can see now we've created almost like a balance sheet perspective here where we're able to see the assets and the liabilities and the way their relationship works together across a set of 4 buckets, basically. But the buckets are very granular in the way they're structured. And so in certain cases, there will be a minimum coverage floor in Portfolio Builder because each bucket is required to have a certain amount of assets inside of it to reduce sequence risk, to give optionality for the investor across time. So that if let's say the stock market is crashing and you're in an environment like 2022 where your bonds are also going down, well, if you own a 60-40 stock bond portfolio and that portfolio is comprised of something like a bond aggregate and 60% equities, well, you become a forced seller of something in a drawdown, which is one of the big no-nos of any good asset liability matching process. You want to make sure that you're temporally diversified so you've got optionality. And so the different buckets are very specifically set with a minimum value so that you never find yourself in a case where you have 0 cash, for instance, or you have 0 of the intermediate instruments. And you can see, again, this is all mapped out across very specific time horizons, mapped to very specific goals, where the probability of not being able to fund these things across very specific time horizons is very low because we've established a set of assets that are very intentionally mapped to a set of different goals and time horizons. And so you can see these all get riskier as they kind of go down. So, we start with T-bills basically, and this is basically a custom cash bucket. You go out to any instrument with a defined duration of 5. VGIT, which is Vanguard Intermediate Bond Fund, has probably a time horizon that could be roughly, reliably in real terms, 5 to 7 years on average. An instrument like a 60-40 fund, interestingly, is a blend of stocks and bonds. So it has an intermediate time horizon. It's not remotely close to cash, but it's also not remotely close to the stock market because it's blended with bonds. And so it's much more reliable in an intermediate time horizon. And so it is, again, being mapped to these very specific time horizons where the sequence risk is buffered. And that's what we're seeing in here. Even though we don't have a 7 to 15 year goal, we are mapping this in such a way where the sequence risk has been reduced because the probability of something like AOR being stable in an environment where the stock market is crashing on a relative basis is very high. And so you've got less sequence risk inside of a rolling 7 to 15 year period by owning something like that. And then you've got your long-term assets. It pushed 69% of the portfolio into all of this long-term stuff, which is, I basically think of the stock market as a 15 plus year instrument that if you hold that thing on a rolling 15-year basis, it will pay you roughly 6% real over that time horizon, 5-6%, something like that. And it's our assets are mapped and also diversified across different time horizons in here, because that's the other thing. In a defined duration model, components of the equity market have different time horizons. And so, for instance, today, Vanguard Total World might have a time horizon of, say, 20 years, whereas the U.S. market actually has a longer defined duration because valuations are very high. So your sequence risk is higher in something like the U.S. market today because valuations and expectations are very high, whereas something like international might have lower sequence risk in a defined duration model. So again, even inside of each bucket, you're diversifying across different time horizons to mitigate and reduce your sequence risk. And that's the main goal of the last component of this. Is it's showing you what is the sequence risk inside of this. And so this is customizable You can start your withdrawal rate at a certain period. You can change the size of the withdrawal rate. You can actually add a shock analysis into this. You can say, let's say we have in year one, we have a huge shock to the market, and let's say that decline is, gosh, let's just be extreme and say it's 50%. You can see this person has a huge amount of sequence risk inside of that portfolio where they don't actually break even in real terms until almost 10 years out in this scenario. So you can map this out and change it and present this in a way where we're now communicating things in a very clear, very tangible manner across the entire methodology. And it's all implemented using low-cost funds. And it can be, again, it can be customized. So for instance, if we throw in an insurance allocation here, let's make it all ETFs. Let's keep it a little bit more simple. This thing will actually, when we generate this, it'll spit out an entirely different asset allocation now, where we've now blocked out an insurance sleeve. I typically will use an insurance sleeve when someone doesn't have real assets or if they're particularly worried about stocks and bonds alone. But in general, this is all very customizable, and advisors can come in and utilize this in a way where they're able to build out these very customized and pretty sophisticated portfolios that are not just diversified across very different sets of instruments, but they're diversified specifically across all these different time horizons where we're mitigating the sequence of returned risk for people. But most importantly, we're mapping very specific assets to very specific goals inside of this. So that's Hourglass FP Pro in a nutshell. So you can see this is a tool that takes a huge amount of work and actually compresses it down into a very digestible and presentable process that is, most importantly, it's completely understandable at the client level, because we're communicating something that is completely different than just looking at something like a portfolio like this, where, yeah, sure, this might be a diversified portfolio, but this portfolio only presents diversification to the client. It doesn't present what is the goal of certain components in the portfolio for me and my life. How is this portfolio helping me achieve my goals? This is a completely differentiated process. Asset liability matching is something that I believe the vast majority of financial planners will be utilizing over the course of the next 10, 20 years, because the process of speaking in time horizons is so intuitive to your average everyday person that it not only, I think, makes much more fundamental sense because it works backwards from a financial plan to the investment management outcomes, but most importantly, this is something that people understand because they now can see in a very tangible way how their specific assets are actually helping them achieve very specific goals. So if you're a financial advisor and you want access to this, I'm updating this and upgrading it all the time. The next few stages are probably going to be building a rebalancing tool and, lots of things coming down the line. But if you want access to this, you want to be a financial advisor who's building something that's differentiated and a process that really communicates a better set of outcomes to clients, then reach out to us and let me know. I will be a point of help in any way possible, because I've seen how helpful this has been for me just in interpreting all of this. And I know that for other financial advisors, something similar will transform their business and be as helpful for them as it has been for me. So thanks for watching, and I hope to hear from some of you.